What's interesting about McDonald's is that you cannot use return on equity to assess the company's profitability. My name is Andrew Stotz, and let's get started with this valuation masterclass case study. McDonald's sells about 9 million pounds of French fries every day. It's incredible. Over 68 million people eat McDonald's every single day. And this is an interesting one. 1 of 8 Americans have worked at McDonald's. My best friend and business partner, Dale, has worked at McDonald's. I have not worked at McDonald's, but I believe that statistic. Let's look at the company's background. Well, it's all over the world, of course. 115 countries, 40,000 restaurants. It's incredible the footprint this company has. And what are the best sellers? Well, let's look at the top 3 products. Fries, Big Mac, and a wrap. Wrap? I don't even remember. I haven't had a wrap at McDonald's, so I guess I got to try that. And 5% of restaurants are company-owned. That's interesting. That makes McDonald's really a franchise business. In fact, if we look at the breakdown of the recent $23 billion of revenue, we can see that 38% was generated from the company-operated stores. So 5% of the stores are company-operated, but they generate 38% of revenue, meaning that McDonald's has to share a lot of revenue with its franchisees. And then revenue from franchise restaurants is about 60%. And if we look at where does that money go, well, those franchisees pay rent, they pay royalties, and then, of course, there's a small initial fee. So what about the revenue breakdown by segment? Well, 40% of revenue is coming from the U.S., and then international operated markets, 50%, and then the 10% is international developmental licensed markets. So generally, we can say almost 50-50 U.S. and outside. So what are the big 5 international markets? Well, there's France, there's Canada, there's Germany, there's UK, and there's Australia. Now let's talk about the company's competitive strategy. And I want to know, does the competitive strategy lead to a competitive advantage? So the company was founded in 1955. It's in the consumer discretionary sector. It's got 150,000 employees, and as I mentioned before, $23 billion in revenue. The main segments are Big Mac, French fries, and also Happy Meals are a big one, right? So what is its competitive advantage? Well, it lies in its strong brand recognition, global presence, and as I've highlighted in bold here, the efficient operations. We're going to look more at that in just a second. But how it achieved its competitive advantage? Well, it achieved it by standardizing its menu, ensuring consistent quality and service, and implementing effective supply chain and franchising systems, allowing for cost control and rapid expansion. You know, I've eaten McDonald's in pretty much every country I went to, and it's amazing how similar the product is. Let's go back in time and meet Ray Kroc. He passed away in 1984, but he was a visionary force behind McDonald's, and he revolutionized the industry. From humble beginnings as a struggling milkshake machine salesman, Kroc took the helm and transformed a small burger joint into a global phenomenon. And his innovative ideas, like the assembly line system and franchising model, propelled McDonald's to unprecedented success. I think you can pretty much say it's the most successful chain in the world. Kroc purchased McDonald's when he was 59. I'm 58 right now, so hey, maybe I can do some big move like that next year. And let's talk about part of what makes McDonald's interesting. Originally, they called it the Speedy System, and it's had a significant impact on the fast food industry. So Richard and Maurice McDonald in the 1940s were dissatisfied with slow and erratic service common in drive-ins, and they developed a methodical approach to food preparation. It's interesting when you look at prior pictures of McDonald's, everybody got their food from driving in, and there was a lot of that. In 1948, the brothers streamlined operations. It's important, right, in the 40s, late 40s, and 1948. It's right after World War II. Everybody's got a car. The economy's booming, so they're driving up in their fancy cars. And basically, they featured a 15-cent hamburger. And McDonald's was founded on this Speedy System and has evolved into one of the world's most iconic and influential brands. So let's look at the key innovations of this. It was a simplified menu, which streamlined and had limited items like only burgers, shakes, fries for simplicity and efficiency. It had a kitchen assembly line. If you've been to a McDonald's, you'll see in the back the assembly line production system to optimize workflow and speed up food preparation. And now many other restaurant competitors around the world, of course, use the same system. And that's why Ray Kroc really revolutionized the industry. And they focus on quick service, delivery within minutes of ordering. You go to a McDonald's, you're not going to wait for half an hour. It's going to come out quickly. And then a meticulous standardization, standardized operations to ensure consistency. Now, what's incredible about the company is that it's generating a 25% or so net margin. According to my calculation, the average net profit margin of companies worldwide is about 6%. McDonald's generates this incredible 25 to 30%. This is more than 2 times the already high 12 to 17% profit margins at Starbucks. And this makes the company one of the most profitable in the world. Apple is up there too, generating a massive 30% net profit margin. But you can see that Apple does it in a different way from McDonald's. So what's the latest news? Well, looking at the 2023 quarterly results, we can see that McDonald's reported EPS of 3.13, which was 17.9% year on year and up 19.7% quarter on quarter. And the 6-month result was about 51.6% of the full year forecast that I'm making in this report. Now, here's an interesting one where Carlyle and Trustar have planned a partial exit from McDonald's China, just to show that, part of what McDonald's does is their franchise business. And so they're thinking about that. Now, let's come back to this point that I said that you cannot use return on equity to assess profitability. First, let's look at this by understanding what's happening with revenue, cost, and profit. 2022 revenue of $23 billion was actually down 9% from 2015, which was at 25.4. But what's incredible about McDonald's is profit was up to $6.2 billion US dollars. And that's a 26.6 net profit margin. That is incredible. Now let's take it a next step and look at the assets. What we can see is assets were up about 33% from 2015. Right now they're at about $50 billion. But liabilities were up 83%. So if liabilities are up 83%, what's happening with equity? That tells us that equity is basically going down and the company's being financed through these liabilities. So let's look at the equity section, and we can see that equity was positive in 2015 but has been negative since then due to share buybacks. Now, in Asia in particular, we're not so used to share buybacks, and we're definitely not used to share buybacks that can turn the equity to negative. Generally, it's not allowed in most of the markets that you can purchase shares, buy back shares to the point where you have negative equity. But that's exactly the accounting methodology in the US for share buybacks. And here, the result of that is that we look at the return on average equity. It was minus 116.5 in 2022. Now, if you just looked at that number on the face of it, you would say, wow, that's terrible profitability. But it's not the numerator, the profit, it's the denominator, the equity that's causing the problem because it's negative. And therefore, if we want to look at the profitability of the company, I would look at return on assets. We can look at return on invested capital, but it still can have problems with this issue of the negative equity. And what we can see is that return on assets is about 12%, and it was there in 2015, and it's there right now in 2022. So basically steady profitability relative to assets. So let's talk about competitive advantage. Is the company financially world-class? Well, here's the method I use as an investor and business owner to measure whether a company has a competitive advantage. The world-class benchmarking scorecard that I developed about 10 years ago with my team. And here's how I construct that scorecard. Basically, I gather the yearly and quarterly financial data of 26,000 companies worldwide. And then we calculate each company's profitable growth score, which is a composite score of both profitability and growth. After that, we rank the company relative to sector peers of a similar size and decile rank them from 1 to 10. A score of 1 or 2 is financially world-class. And then we assess the company's performance over the prior 4 years and the past 12 months. So is the company financially world-class? When we compare McDonald's against 960 large consumer discretionary companies, we find that McDonald's is definitely world-class. The ranking is at a 1 or 2. And really, it's back to 1 now. It was down to a 2 during the COVID time. So, is your company financially world-class? Just message me and I'll score your company just like this. But let's now wrap up by trying to understand what's the value of this company. Should someone consider looking at buying this company? Well, here's the estimate on free cash flow that we've made here. And going through this, you can see a pretty steady free cash flow over the years. And if we discount that free cash flow at a weighted average cost of capital of about 7.7%, we can see that the free cash flow of the firm and the free cash flow to equity are very close to the price in the market. As a result, I wouldn't say it's a screaming buy at this point, but what I would say is that it looks interesting now. And next, let's just look at the PE and price to book. The PE is at 23 times versus the US PE ratio of 28 times. Now, of course, the US PE ratio is supported by high PEs at tech companies. But if we look at PE ratios around Asia or around the world, McDonald's is still reasonably priced, I would say. And they're producing about a 14% earnings growth that I'm expecting in 2023 and maybe 5% in 2024. Now, finally, the price to book doesn't make sense because equity is negative. So book value is going to be negative, and therefore price to book value is going to be negative. Return on equity is going to be negative. So we cannot use, in fact, what I'll just do right here is just highlight that we can't use price to book as a valuation methodology here. So what is your company worth? Message me and let's discuss the value of your company.